Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com tells us the Santa Claus rally was on with major markets up for the last 4 weeks. He checks in on gold and silver market activity. John Rubino, author of several books on the economy, including The Money Bubble, digs into various scenarios that could affect the markets, including pandemics and the U.S.-China trade war. He tells us why it might be prudent to have some gold and silver coins on hand. Joseph Schachter, founder of the Schachter Energy Report, gives us a detailed rundown on what he expects to happen with oil and gas in the new year. Plus, at the end of the show, we'll have a company showcase update from American Manganese CEO Larry Reaugh. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Best of the season, Ross?
And a countdown to Christmas, and best to you, Jim.
Ross, we're coming up to Santa Claus visiting, and the market's still charging higher.
They are. We're in one of those melt-up fashions right now. I mean, you get a correction for 2.5 days, and then it just keeps going. But guess what? It's December, and Decembers tend to be exceptionally good, especially as you're moving towards the end of the year. How many times have we talked about seasonal rallies in the equity markets? When you hit the middle of December, things really come to life. Last year was a bit of an anomaly where it sold off into December the 24th, but then made its turn. So, here we are year to date. You got the S&P up about 32%. You got the Toronto market up 20%. Now, a lot of that is because of how bad things were at the end of last year, but still, the S&P is 9% over its previous all-time high. So, you got a positive Fed out there. They're very dovish. They're willing to keep liquidity into the system, and it's happening around the world. When you had that hiccup in the overnight rate back in September, and it scared a lot of the Fed watchers. Since then, they've made sure that there was lots of money available to keep things going. Eventually things will come home to roost, and there will be a pretty hard correction. But for right now, the trend is up, and we tend to look at various seasonal factors, and I would look at cycles. So we've got a decennial cycle. We take a look on the equity markets going back all the way to 1900. You see what happens at the end of the ninth year of the decade and into the first part of the first year. We've written a couple of reports on that one, some fairly definitive action that we can be looking for. Then also you take a look at the presidential cycle. So here we are coming up to a presidential year. Historically, the year ends up doing well overall, but can be some pretty big hiccups along the way. And there's some characteristics that we look for in January, and again as we move out to the end of February into March, that can provide both selling and new buying opportunities. So we're going to be on the lookout for those as we move through the next couple of months.
Bob Hoy mentioned on his show earlier in the week that the U.S. housing builders' confidence level is at their highest level in 20 years, but you notice there's something you should also pay attention to when it comes to that.
Oh, yeah. You have to be careful about confidence levels because they can change so quickly. It was just over a month ago that the ETF of the U.S. home construction builders, the ITB, index, that was showing tremendous exuberance on the upside to the point where the relative strength indexes and our exhaustion model flashed major warnings, say probably 5 weeks ago now. And since then, the index has gone nowhere. It's just flatlined. And this is with improving fundamentals, quote unquote, coming out that are supportive in terms of housing permits being at a 12.5-year high, housing starts 3% above, best estimates. So you're getting a lot of positive news, but you're not seeing the movement in the stocks. You've got a few limited items, maybe like a Home Depot, that have sold off and are bouncing back. But overall, the index is looking a little heavy. And the last time it looked heavy was back in 2006, 2007. So this might be a little bit early in terms of, a big warning in terms of things rolling over. But in a lot of these cases, it pays to be early rather than late. Rather have cash in hand rather than trying to find somebody else who's willing to buy something from you.
How's oil been doing over the month?
Oil has been just slow and steady. Here we are flirting with the $61 level in this last week or so. This is just for us just beautifully on track. I think we closed the week off at about 60.60, and the cycle work here still is for the fourth quarter of 2020 to be a significant high, and how we get there will be important. Right now, we are close to our targets. Originally, it was $62 we've been targeting towards. The band that we look at, it's a moving average band. It's now up around 63, so a little bit higher than the original projection when we were down at 52. And we're getting the first sort of precursor signals here to an interim top. We had 9 consecutive days with highs or with closes above 4 days earlier. That creates a sequential sell alert. Had that in the middle of the week. Usually at this point in the cycle, you'll top within a week to 10 days. So somewhere probably before the end of the year, if we were to be in the $62 to $63 range, you could be looking for a high up there. And the first really good correction since we had back in October. And, when we were at $52 and right at the bottom of the support channel, when we then had projections up where we are now, you look at the XLE or the XEG, the U.S. and Canadian oil ETFs, they're up 9 and 15% respectively, without any real breaks along the way. So, if we get overbought, then clearly you would want to be taking some money off the table with those ones.
And we'll have more on the oil market with Joseph Schachter coming up just towards the end of our show. How are the precious metals doing right now?
Well, you're at one of those sweet spots. The November, December typically create a low for gold and more often even for silver. And from here through a January or February stretch, you typically will see some pretty good strength. We put out a special report on silver here 10 days or so ago because it really just had a beautiful setup. It had been in a trading range, went down, and for a day or two took out support and then sprung right above that support. And that's usually what you see on the kickoff to a good move. So silver has, I guess, we had about a 5 or 6 week high at the end of the week. This is looking really good, and the stocks are doing exceptionally well. I mean, take a look at something like a Pan American Silver. I think we're sitting at a 4-year high right now. So these silver stocks have got a lot of buoyancy. The gold market, it's still having trouble getting to like 1483. That really needs to get through the mid 1490s to 1500 as a catalyst to get it going. And, maybe it'll be a U.S. dollar move that sparks it, but for us at this point, it's one of those items that has got potential. It just hasn't shown that sign of life yet.
Russ, thank you so much for being on the show, and best of the season.
Best to you, Jim, and to all the listeners.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, John Rubino next on This Week in Money.
Always consult your investment professional before making any investment decision.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Hey, Jim.
John, you have a lot of fans out there. One of them is Robert in Vancouver, who sends a listener question to kick off the show. And he's quoting Bill Gates, who's very concerned that there could be another global flu pandemic. And he took a look back to 1919, when something like 500 million people became infected with the Spanish flu, and 52 million of them, a conservative estimate, died from it. Could we face a similar epidemic again? And what kind of an impact would that have on the markets, the economy, even the social fiber of our society?
There are lots of different levels for this kind of a discussion. One is, we think we have it hard today sometimes, but those people back then fought World War I, which was the nastiest war that had ever been. And before it even ended, they had a global pandemic that killed more people than World War I killed, and imagine that. Imagine that decade that you hope you live through, but there's a good chance you wouldn't live through it. So, that was a horrendous thing to happen, but something like it is guaranteed virtually in the next few decades here, just because microorganisms are constantly mutating. And sooner or later, this random number generator thing that's going on throws out something that is both deadly to humans and really communicable. And in other words, a flu-like thing that spreads and kills a lot of people. We've got these mega cities now. We're much more populous now than we were back then. And a lot of people are concentrated in cities of 10, 15, 20 million people. So imagine that a really nasty, really contagious disease gets going in that kind of an environment. It's completely possible that 1 billion people would be killed by something like that. Now, that would crash the global economy, obviously, because we'd all hunker down. Businesses wouldn't work right anymore because half their people were homesick and or dead. Nobody would be able to travel. So people wouldn't be out shopping, they wouldn't be in restaurants, they wouldn't be flying, they wouldn't be driving, which means that you could selectively, if you were going to take the how can I benefit from this approach, as an investor, what do you want to do with your money? Well, you want to short the airlines, obviously, because they'll all go bankrupt. And restaurant chains, same thing. You just won't want to be out in public. Movie theaters, all of the kinds of businesses where people congregate would just cease to exist in a world with a serious pandemic. But the rest of the economy would be debilitated as well, and that's the kind of risk that is always out there. So we don't think of it because it's not something that we can cause or prevent. It's just in the nature of life right now that big diseases happen. And because we now have 7 or 8 billion people on the planet, most of them in close proximity to each other, when the next big pandemic comes, it'll be devastating. We know that. but we can't say when. We can't say how it starts. Therefore, we don't include it in our financial calculations. But it probably should be added to the list of risks that you plan for. You know, I think a certain level of prepping is good for everybody, no matter where you are and no matter what you think of the future. There are probably things that would mess up your life if they happened, and they have a maybe a small but a real chance of happening. So you ought to prepare. You know, have some extra food in your garage. Have an emergency bag in the trunk of your car. You know, I just noticed they sell those at Costco, $99 per backpack, and it's got, you know, a compass and a knife and some extra food and things like that in it. Have one of those in the trunk of your car. Always have gold and silver coins. See, they're not just for a financial crisis. They're also for other kinds of societal disruptions, because the fiat currency system is inherently fragile. And pretty much anything that messes up the rest of society will make the banking system less reliable than it would have been otherwise, and probably lead governments to print huge amounts of new currency to try to bail out everybody who's affected by whatever disaster it is we're talking about. You know, and here, I just heard about the Cascadia subduction zone, which I didn't know anything about before, but the entire northwest coast of North America has a giant earthquake coming with a tsunami soon to follow. You know, so if you're around here in the Vancouver area, for instance, that's something that's got to be on your list of crises. So the pandemic thing is just one of a long list of conceivable things that can screw up your life. So it makes sense to prepare for, you know, the generic crisis, and hope that your preparation works for whatever specific thing comes. Because I really doubt if most of us get through our entire remaining lifetimes without some kind of a big crisis. I mean, the financial one is guaranteed. That's baked into the cake. But there are so many other things that could happen too, that it makes sense to be ready, at least on some level to some extent, for whichever one happens. And I think that the prepping philosophy is so well established now that there are all kinds of sources of information on how to do it, that it's not really that hard to do. You've got people who will give you a list. Go out today, buy that list, put them where they're supposed to be, and then you're kind of prepped, so you can do it. But the pandemic thing is definitely on the list, and it becomes scarier with time as human populations continue to increase and as the antibiotics that we're misusing stop working. You know, we're heading for a time when the stuff that used to cure strep throat in our kids and all the other diseases that we no longer really worry about, when those antibiotics stop working. And when that day happens, we go back in time a century to when, you know, women died during childbirth regularly, and you had 8 kids because you only expect 4 of them to survive. You know, that's the kind of world that our great-grandparents lived in and took for granted, because that was just all there was. And then we had this brief, in retrospect it's going to be brief, period, when we came up with antibiotics that kill most of those microorganisms that used to wipe us out. But we're misusing them on such a vast scale in agriculture, and it's the nature of microorganisms to mutate and to develop resistance to whatever you're throwing at them. And major pharmaceutical companies are not coming up with nearly enough new antibiotics to replace the ones that stop working. There's a good chance we enter a period where stuff we didn't used to think about can kill us again. Which just increases the odds of some kind of a pandemic. You know, maybe something comes along that used to be fixable with one of today's antibiotics, but that antibiotic stops working because that microorganism has mutated and developed resistance, and then it turns into a pandemic, and we have nothing to do, you know, nothing to fight it with. And very possible. Now I'm starting to worry myself. That's not something I've really thought about lately either.
Well, unpleasant thoughts aren't, I think, all that natural to most of us. We like to think about the good times and how to continue them.
Well, and we've lived in a really blessed period, in the age of antibiotics, in a period when there hasn't been a major war, and when in the period of a credit bubble, when money's been available and there hasn't, we've been able to moderate poverty by printing a lot of new money and getting away with it. Those are all finite periods of human existence. And we've lived through all of them. It's been a really surprisingly nice time, or at least people will look back on this as the good old days, even though they don't always seem that great to us right now. But compared to what could very possibly be coming, this is a really smooth stretch of life highway. And so, yeah, I think that we've been trained not to worry. And our ancestors would have found the current attitude of, everything will be fine because the government will make it fine, or things just work out. They would have found that attitude to be shockingly naive, because back in the day, bad things did happen, and you needed to be aware of them. And now, most of us have had it so good for so long that we've lost that sense of healthy anxiety about the statistics of the world. In other words, about the stuff that could happen. But I think nature, because it's cyclical, is going to take us back around to needing to worry about stuff one way or another. Like I said, I think it's the financial crisis that's the most imminent, most likely. That the fractional reserve banking system / fiat currency regime that has ignited and maintained the financial asset boom of the past 30 or 40 years, that's going to go away in a blaze. It's going to blow up on us one time in the not too distant future. And it's going to take us back to a time like prior to the Great Depression, or actually during the Great Depression, when banks were not government insured and you could lose all your money. So people naturally worried about their finances back then in ways we don't. Well, we're coming back to a time like that when there are going to be all kinds of current behaviors that are going to turn out to be horrendously mistaken in the not too distant future. And a lot of people are going to wish they had thought it through better, about where they kept their money and what they kept their investments in, et cetera, because it's going to come back to bite them.
John, do we really have a trade agreement between China and the U.S., at least phase one? We keep hearing from the Chinese, they don't think it's a done deal, but is it? Well,
even if the way it's described, it's a done deal, it's not much of anything. It's China's going to buy a few more stuff, agricultural products from the U.S. And they definitely aren't going to buy as much as the numbers seem to imply, because the world doesn't produce enough wheat and soybeans, et cetera, to soak up that kind of demand. But even if they do sign this deal, it's not the deal Trump was going for, because he was trying to address intellectual property theft primarily. And a lot of China's other rules, like certain markets are closed within China even while they're open here. And when you want to start a Chinese division, you are required to partner with a 51% ownership Chinese company and then hand over all your intellectual property to that company, which then hands all that property over to the government. That's what Trump was trying to address. And he doesn't seem to be anywhere near achieving that. So if all he achieves is that China agrees to lower the trade deficit a bit by buying a bunch of agricultural stuff for you, that'll get him a lot of votes in the farm states in the U.S. So in a political sense, it may be a good thing for the current U.S. government, but it won't address the reasons for the hollowing out of the U.S. economy. We basically, over the last 30 or 40 years, sent all our unionized manufacturing jobs overseas to places where the people make a fraction of union wages, and then sell us back cheap stuff that they make, while our people here are knocked 2 or 3 rungs down on the economic ladder. You know, it used to, a assembly line job for GM or Ford or somebody like that used to be a middle class job. You know, you could live in a decent house and have a nice car and put your kids through college on that kind of a job. And those jobs just evaporated in the last 30 or 40 years. And the people who had those jobs, well, the reason we have Donald Trump as president is because the people who had those jobs found themselves being ignored by the major political parties. In other words, both the Republicans and the Democrats seem to be saying, you know what, it's your own fault how you ended up here. And learn to code, you know, go get a computer programming degree, and then you'll be okay. But Trump came along and said, you know what, I'll get those jobs back. I will slap tariffs on cars if our car makers move the production overseas, and I will build a wall to keep out the immigrants. And the people who felt like they'd been left behind and ignored by the main political parties ate that up. You know, that was what they wanted to hear from their leaders. And so they elected Trump. And now you've got Bernie Sanders, who's one of the leaders in the Democrat nominating race here, who is coming at the same issue from the left, where he's saying, yeah, everybody, you know, the working class people have been left behind by the system. So, but instead of saying we're going to, you know, pick a trade fight with China or build a wall, he's saying we'll give you free everything. We'll give you free college, free housing, free health care, and we'll basically just take care of big chunks of your life for you. And that is probably going to resonate too. So we could have a very interesting election coming up between right-wing populism in the form of Trump and left-wing populism in the form of Bernie Sanders. And so we'll find out which form of populism actually resonates with the people who feel like they've been ignored for all these years. I think it'll be fascinating. It'll be great political theater. I don't know if it amounts to anything because, like I said, we spend all the money that we would normally use to fix these problems. So it's not clear how we offer free health care to everybody and free housing and free college when we're already running $1 trillion a year deficits before we start trying to do that stuff. And it's not clear how we maintain a global military empire that costs us $1 trillion a year when we're borrowing a big chunk of the military budget, in effect, from China. So the stuff that we in the U.S. and in most of the rest of the developed world kind of take for granted will go away when it becomes apparent to everybody and to the markets that, you know, we already spent that money. It's already gone, and we have to live much smaller going forward, or we have to inflate away our currency to buy ourselves another decade, after which we have to live much smaller. You know, there's no real way out of having to live within our means going forward, which means in the U.S. we live on a couple of $1 trillion less each year, which means a return to, you know, the lifestyles of the 1950s in a lot of statistical ways. In other words, smaller houses, smaller cars, college that you have to, you know, work while you attend to pay off, and things like that a lot of middle-class Americans thought they'd left behind long ago. And, you know, I have a series on dollarclass.com called Welcome to the Third World that chronicles the ways we're regressing. You know, we're going back to the way it used to be, which is to say the way it is now in a lot of developing countries. For instance, we're in San Francisco and in a lot of California, there's a resurgence of these weird diseases that have been wiped out for the longest time in the U.S., and they're coming back. And they're the kinds of things you get when you live in a place where there's not good sewage treatment, you know, and the water has microorganisms in it that make you sick. Stuff like that. It's coming back in the U.S., and libraries are closing because cities can't pay their pensions at the same time as maintaining current services. And the federal government is just flat out going broke here pretty soon. And that will manifest as a plunging dollar because the government is now manipulating interest rates, which that used to be one of the indicators of a financial crisis. You'd see the fixed income markets get really erratic. but the government is now manipulating interest rates to hold them in a range that makes everything look like it's okay. So that shifts the pressure over to the currency. So we'll see the major fiat currencies of the world just start to decline in value, and then that'll become a waterfall decline where everything just kind of falls off the table at some point in the future. And I'm hesitant to say it's imminent because I've been saying it was imminent for a long time. It's felt imminent. The numbers are crazy, but we haven't collapsed yet. But by not collapsing, that just basically means we have had more time to borrow even more money to make the eventual collapse that much more serious. So, it all comes back to precious metals in the investment thesis part of this. You want to buy gold and silver. You want to own the kinds of money that aren't wiped out when governments panic and start inflating away their currencies. So gold coins, silver coins, see, that's a big part of the prepping that we talked about earlier. If you think there's a natural disaster coming, then you want to prep in a certain way. If you think there's a financial crisis coming, you want to prep in certain other ways. But across the board, you want to have some gold and silver coins because they will be real money no matter what else happens. People will still take those things and attribute value to them and give you usable stuff in return for your precious metals. So you definitely want to have some of those. And that might be the starting point for getting yourself ready for one of the many things that are coming.
We'll have more with John Rubino when This Week in Money returns.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYVresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Rubino. John, do you have any idea what's going to happen with the stock market in the new year?
Well, there are two ways of looking at stocks right now, and they're mutually exclusive. One is that they're wildly overvalued. By any measure you want to use, stocks are at the point in terms of their valuation that they were prior to the last couple of crashes. In other words, we're back in 1999 tech stock territory or 2007 bank stock territory, which means that if history is any kind of a guide, the stock market is going to tank in the next few years. However, there's one big difference between now and those previous times, and that is that the rest of the world is in even worse shape than we are. And there's a ton of capital out there that could flow into the U.S. If you're in Europe and you look at what's happening in France and in the possible transition of power from Germany away from Angela Merkel's coalition to something that's a lot harder to predict, or Italy, where the banking system is basically moribund and the bond market is starting to flake out again. If you're one of those people, if you're a person in one of those places and you got some money, you want to get it out of there because you don't trust your local system to keep functioning. Where do you put it? Maybe the U.S. That's one of the places that you would send your money. And it's even more true for people in Brazil or China or possibly India. And that means there's a lot of capital that could flow into the U.S. And, when you're desperately trying to get your money out of your country because you're afraid that it's going to be taken away from you, you're not really price sensitive. So people like that might be willing to buy U.S. stocks at very high valuations. They've been willing to buy Vancouver real estate, right, at insane valuations over the years. So why not buy U.S. blue chip stocks? That could happen, and it could send stock prices up from here, and make valuation irrelevant for a time. That would result in an even bigger crash at some point in the future, but it means if you short today's market, you could lose some money. So I honestly don't know which one of those is more likely. They're both possible. So it's a really tricky proposition right now with stocks, because most people who are listening probably have some mutual funds, right? You own stock, or your pension plan owns a lot of stock. So you've got a stake in what happens here. And I honestly don't know what to tell you, which way to go, because those two scenarios are mutually exclusive. You know, in one case stocks go up, in one case they crash. So there's two ways to approach a situation like that. One is you diversify by playing both sides of the fence. You know, you short some stocks, you raise some cash by selling some existing stocks, and you keep some of your stocks, or you buy some new stocks. That way, something will probably work out, right? And you might maintain the purchasing power of the capital you put into that play. But that's not a way to get rich or richer. That's just a way to not lose. If you want to actually make a lot of money in stocks, you have to pick a side and you have to jump on it. And I don't know what to tell you yet. I'm long precious metals mining stocks and short a few regular equities like Netflix and you know, an S&P 500 fund, things like that. And so far the gold stocks are working out real well, and the shorts are not working out real well. So we'll see. I don't know. I think over time I will probably add to my shorts. If the market keeps going up, I will keep shorting on the assumption that even if we have a couple of years of rising stock prices from here, we're in nosebleed territory and valuations will eventually work out. In other words, fundamentals win in the end, but there are times when unnatural things happen that can kind of bend financial law for a while, but eventually fundamentals do win in the end. And I would tend to kind of feather into the bet that fundamentals will eventually win out, and accept that there might be a few painful years while that process works itself out.
Batteries for electric vehicles, should people be investing in the metals needed for those, like lithium?
That's a growth industry, battery metals. So in general, yes, those are probably things that will go up in price, which means their mining companies will go up in price, in their share price over time, and it'll work itself out. Now, with lithium, there's kind of a difference of opinion out there about how much lithium there is. Some people say there's going to be a big shortage because there are just going to be so many batteries demanded in the future, and other people say, well, there's plenty of lithium though. You know, there could easily be a glut once a lot of the new mines come online that are being planned right now. And I wouldn't hazard a guess about which of those is true. That's a mining expert question, and I'm definitely not one of those. And there's another issue here about how the whole technology of electric cars shakes out, because batteries aren't necessarily the only way of powering electric cars. And fuel cells, which run on hydrogen, are very interesting, and they're falling in cost. And hydrogen is one of the most abundant things on Earth. It's very easy to get hydrogen. Right now it's kind of expensive, but the technology for turning water into hydrogen gas is also getting cheaper over time, or getting more efficient over time. So you would expect hydrogen to fall in price and fuel cell technology to become more efficient. And the question is, do those things happen quickly enough to challenge batteries in the electric car market? And again, I don't know. That's the dynamic, but I don't know how fast all of this progresses. But if there were some breakthroughs in the fuel cell market, that would mean that maybe batteries are actually challenged for supremacy in the electric car market, and maybe we won't need as many batteries and as much battery metal going forward. So all of this is tricky, and that's the way it is with new industries that are growing exponentially. For instance, solar power has grown amazingly, beyond almost anybody's prediction from, say, 10 years ago. But there hasn't been that much money to be made in solar panel makers because there are a lot of them out there. And as the price of solar panels go down, it's hard to make a lot of money when, your inventory is falling. The price of what you're selling is going down. So you're in a growing business. You're selling a lot more solar panels, but you are not making a fortune at it. And your investors who own your stock are maybe making some money, but they're not making tech stock circa 1997 kind of money. And that's good for society because we want these new technologies to come along quickly and to improve exponentially. But it makes the investment thesis, which begins with, this industry is growing like crazy. I want to get on board. It makes it tricky when you go to the next stage of that thesis, which is, I'm going to buy this particular stock. That becomes really hard, because so much is changing so quickly. And, if you go back, for instance, and look at the computer industry, when it was young, the big names turned out not to be the ones that made the fortunes for people in the stock market because new companies came along, which did better than the first movers. And they became the big players in the computer market. It could easily be that again in the electric car market or most any tech market now. They're changing dramatically. They're going to fix a lot of our problems when they mature, but it's not clear how you make a lot of money from them as an investor right now. So my advice in the electric battery market in general is just be careful and try to go for quality early on the assumption that in a market that's changing really dramatically, you want financial strength and you want the ability to weather a glut in that market. You don't want to be investing in one of the companies that ceases to exist when prices plunge unexpectedly. You want the company that had a lot of cash on hand and that bought up all the equipment of the company that went bankrupt and can now produce those products at half price because they bought all that cheap equipment. So the little story stocks in a hot market can sometimes go up by 10,000%, but 99% of them cease to exist. So leave those for the experts on that technology and stick with the highest quality names if you want to play in these markets.
What do you see ahead for real estate?
Real estate is sort of the same story as the stock market. Grossly overvalued by historical measures. But interest rates are going to have to go down dramatically from here. No matter what any central bank in the world says right now, the general trend of interest rates is down. And you've already got 1% mortgages in some parts of Europe. So it's not clear what falling mortgage prices will do in the U.S. and Canada, for instance, to real estate prices. So say you've got a slowing economy that leads the central bank to cut interest rates dramatically. Well, the slowing economy hurts demand for real estate, but the plunging mortgage rate makes the remaining buyers able to buy a lot more house. And that helps real estate prices. So here again, if you're just looking at historical valuation, you want to short the housing stocks and you want to short the mortgage bankers and you want to sell your house and move into an apartment for 5 years and then buy your house back for half price. That's what you would want to do just based on valuation because that's what worked in 2007, right? If you sold your hot market house in 2007, you could have bought it back for half price. In 2009 or 2010. Same thing will happen again if valuation still matters. But if we have massive capital flows into the U.S. and Canada and the central bank pushing interest rates down and mortgages go to zero, I would buy a house just on principle if mortgages were zero, just to be able to say I did it, that I got a 0% mortgage, because that's one of those things that a finance guy fantasizes about, and it never happens. It has never happened in human history. other than a couple little tiny European markets where you could buy a house, take out a mortgage, and the mortgage bank would pay you instead of you paying them. But when we see that, and not if, but when, we will see pretty close to zero rates on mortgages at the bottom of the next cycle. It is hard to predict what that will do to real estate prices because you got these two competing forces. Slowing economy is bad, extremely low interest rates is good. And I have no idea how it'll play out. I wish I could be more definite with this stuff because there are times when you can point to things and say, okay, this is a screaming buy. Just do it. And this is not one of those times for a lot of financial assets out there. Really the only thing that I look at and say, obviously, you want to buy this now is silver. Because silver is crazy cheap, even compared to gold. So gold should do very well going forward in the kind of financial system that we're looking at. But silver should do even better. So that's an easy thing to say, go out and buy silver, go out and buy gold. But with this other stuff, it's much trickier and a lot harder to have a definite thesis. So I wish I could be more deficit and the deficit is on my mind, as you can tell, Jim. But I wish I could be more definite and lay out a portfolio for the average person that would be guaranteed to work. But this is not one of those times. And because of that, people should be very careful about the chances they take in the financial markets because it could go so many different ways. And several of those ways can hurt you while just one of those ways can help you. So it's very dangerous.
Do you have any outlook for the Canadian economy and the Canuck buck?
Well, it's possible that we're heading back into a commodities upcycle. And that would be great for you guys if it works out. So let's say we settle this whole trade war thing and the governments of the world respond to the coming economic slowdown with really aggressive infrastructure plans. And in other words, borrow a ton of money, use it to build buildings and roads and airports, and basically upgrade the infrastructure of their country. China did that after the beginning of the Great Recession. They basically quintupled their debt, and they bought more cement and iron ore and copper than anybody else had ever bought in that short a time. Say there's a coordinated program like that out there, which there probably will be, because there's nothing left to do at this point if there's another recession except spend a ton of money on real things for governments. And that would push up the price of a lot of commodities. So you would have that happening at the same time. You would have a shift to electric cars from internal combustion engines, which would drive up the price of a lot of the metals that go in electric motors and the battery packs. And that all might be really, and probably an upcycle in gold and silver. All of that is very good for Canada and for the Canadian economy and for the Canadian dollar. So it's possible we'll see parity again with the U.S. dollar in the next cycle, which means I better get up to visit you guys soon, right? Before you're priced out of my financial range. But that'll be great for Canada, and it'll be a big problem for the U.S. So good luck to you. Maybe I'll get a condo in Vancouver. Is there any cheap real estate around you now, Jim?
Well, the prices have come down, but I still wouldn't describe them as cheap.
Yeah, I think maybe when the 0% mortgages kick in, we'll be neighbors.
John, thank you so much for being on This Week in Money.
Thanks, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Coming up, Joseph Schachter, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Joseph Schachter. He's the founder of the Schachter Energy Report online at schachterenergyreport.ca. Joseph, welcome back to This Week in Money and best of the season.
Best of the season to you and all your listeners, and it's good to be back with you.
Joseph, are we likely to see sub-$50 oil in 2020?
I don't think so. I think in the December, the decision by Saudi Arabia to, number one, move forward with the Aramco deal, and then number two, to make sure that it was successful, they did a cutback in November of about 151,000 BOEs a day to 9.85 million. And then they made the decision that OPEC as a whole would cut back in the first quarter 500,000 barrels a day, of which they would take 400,000 barrels a day. And that really is a game changer to me, a game changer. Historically, Saudi Arabia was seen as a market share player. Now they are a price hawk. They want higher prices because they want Saudi Aramco to have higher revenues, higher cash flow, higher free cash flow, and have the ability to increase its dividends so that the stock price goes up. Because they only sold, 1.5% of the issue. They were originally going to sell, 5%. And what they want to do in the years ahead, which a year from now they can start selling more paper in 2021, they want to be able to sell more, hundreds of billions of dollars of stock and lower their ownership, and in return use that money to diversify their economy. So they've gone and changed from being a market share player to a hawk on oil prices. So I think the $51 that we saw, a number of months ago was probably the low. We've rallied into the 61, 62 area, and we're about $60 today. And I think, the low in Q1 might be 54, but I think we're looking at high 60s in the second quarter. And I think in the second half of 2020, as we see stronger economic demand, we're also looking at a U.S. election cycle. You've got the UK and the US looking at a trade deal. You've got, China and the United States resolving their trade issues. So we're going to see stronger economic growth create more demand. At the same time, U.S. energy producers are looking at more fiscal control. They're looking at not growing volume so much. We're looking at right now the U.S. producing 12.8 million. Most people have thought they'd be about 13.5 million barrels a day right now. So lack of spending and cutting back on the drilling, as we see from the weekly Baker Hughes report. The activity levels come down significantly. The rig counts come down significantly. And so I think that we're going to see maybe only 13.5 by the end of 2020, which means that the extra demand is going to tighten up inventories and keep prices higher. So I'm totally in the bull camp, and what I'm recommending to our subscribers is anytime we see dips, and I think we might see a dip in Q1, and that will be the time to add to your positions. In addition, a lot of stocks have been hit by tax loss selling and are still near their the yearly lows. So I'm thinking and recommending to people to take advantage of those names. In our most recent report, we highlighted quite a few names that we think are very cheap and recommended where we thought they would be extremely attractive buys for them to take advantage of between now and year-end.
Has oil suffered enough for a sustained rally?
We've been in a kind of a up and down market since 2014. The last time we were at $100 oil. In 2017 we got up to 77. This year we had a high of 66. You remember last year December we were 42. So we've been trading under the replacement cost of energy. So the industry is not making money, and so we're seeing volumes come down from many companies in terms of their production level. And at the same time, many of them have debt problems, so they've even allowed production to go down more as they take cash flow and use it to service their debt and pay down debt. So I think that we're now ready, not for for a rally. I think we're ready for a significant bull market. And I think over the next 3-4 years, not only are we going to see $70 oil in the second half of 2020, but I think we're looking at $100 oil again sometime in the next 3-4 years. And that will create significant upside for these stocks because, number one, they'll have much more higher cash flow than they do today, but they'll also start trading not at desperation levels because of their debt loads. They'll be trading back to their normal multiples of cash flow multiples, price to NAV, and that will create significant upside. We think the index, which is trading now, in the 140 level, potentially could go, potentially to, back to the all-time highs. We're 144, and the index high, I think, was 470 in 2008. I think we could see that get back above that level sometime in the next 5 years. So I think there's potentially from the index a 3 or 4 times move over the next 4 or 5 years. And again, if you buy the right stocks, you should be able to outperform that because the heavyweights are like C&Q, Suncor, Cenovus, Imperial may not do as well. And so if you have more entrepreneurial names that are faster growers and do well with the drill bit and have good financial management, those companies should outperform. So I'm quite excited, and I think that, anytime you see weakness, take advantage of it. The stocks in the last week or so had a bit of a bounce on. We're seeing a bit of weakness at the end of the week. I think, in the next, few weeks, if we do see more downside, it'll be, a very, very attractive opportunity for investors to nibble away on both the energy and the energy service stocks.
The oil high of 2019 was in April at $66.60. That's a 666 number again at market highs or lows. Do you think the price of oil is manipulated?
Well, you could argue that it's manipulated because you've got a lot of hedge funds and commodity funds that are involved. You also have, of course, OPEC, wanting to see prices move in certain directions. Right now you have, and one of the reasons why I think there'll be some pullback in the price of oil is we have speculators with near 500 million barrels long. That's near a high end of the range, so the speculators are just a bit too bullish. So I think we're going to see a pullback they'll retreat and lower their exposure. But I think that given the fact that the sector has done so poorly and is so underinvested and people are ignoring it because there's been way better places to invest for the last few years, my key thing is that I think that we're looking at a commodity boom because central banks around the world are reliquefying the system. They want to, they know that there's massive debt loads out there, and so they're trying to make sure that the system stays liquid. And so you're seeing the Fed in the States, you're seeing, ECB, you're seeing Japan, everyone on the central banks providing more liquidity. And so that's going to cause some commodity inflation because we really haven't seen a lot of money spent on commodities in terms of expanding capacity in a long time. And if you look at inventories on the LME and other places for copper and many of the other, base metals and the same thing with precious metals, we're beginning to see that the CRB is starting to act better after really underperforming for quite a few years, 5-6 years now. So I think that that's going to set the stage, and I'd be watching the CRB. And if we see that take off, and we see copper take off, and the grains take off, and energy take off in 2020, I think it's going to be very clear that we're going to have a sustained multi-year bull market across the commodity board. And, for other people who are your experts on base metals and precious metals, they can tell you what they think and where people should invest. For the energy and energy service sector, that's where our space is, and that's where we're focused on.
Have oil stocks been under pressure due to tax loss selling?
We saw it earlier. Last year we saw it in the fourth quarter. This year we saw pressure during the third quarter, and we're still seeing a little bit of it right now. We're seeing some stocks on my board in front of me trading within a few percentage of their 52-week lows, more on the service side and the natural gas side on the weaker side, because of oil prices rally from 51 to 62 and 60 today. More of the oily names have done better, but the natural gas stocks and the energy service stocks are where the bargains are, as I see it right now.
We'll have more with Joseph Schachter when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Joseph Schachter. Joseph, are geopolitics likely to play a big role in oil during 2020?
I think every year they do, and every year they will. Of course, OPEC and activity within OPEC, what's happening in Libya, what happens in Syria, what's happening in Venezuela, what's happening with Iran, probably most importantly, if there's a change in leadership in the U.S., with the Democratic, if they win, be more amenable to a deal with Iran and then remove the sanctions from them. There's lots of wild cards on the international side, and every year there's something that causes spikes both up and down based on geopolitical events, and I don't see that disappearing. I think the reason why I think we're going to see all-time highs above the 147 that we saw in May, June of 2008 is because I think at some point, somewhere down the year, in the next 4 or 5 years, we may see some geopolitical event impact negatively one of the producers. And if that's the case, then the removing of some significant amount of OPEC production could cause a price spike like it did in Q2 of 2008.
What do you see ahead for natural gas in 2020?
Yeah, right now natural gas, we're waiting to see, the winter, which usually, the big drawdowns usually occur in January, February. And so it's a North American market, and we're about 220 for the U.S. right now, and about 220 for ACO right now. I think Canadian prices will firm up as we get closer to LNG. Plus, we have more demand, more takeaway demand coming, or more takeaway capacity coming in 2020. We also have more within Alberta demand occurring. So I think we'll see at some point even, prices in Canada in Canadian dollar terms being above the U.S. price. But the problem internationally is that there were a lot of new LNG facilities that came on in the United States, Australia, etc., that there's a bit of a glut on LNG on the international side. It's going to take a year or two for that to get consumed, and that's why I think it's very appropriate and timely that LNG Canada, the Shell project, is going to come on in 2023, 2024, and by then the excess capacity will be used up, and prices should firm up, and there should be a shortage at that point, which would be a great window for the Shell capacity to come on. And at that point, I think we'll be looking at over $3 for ACO, which will be very lucrative for the Canadian natural gas producers.
We're hearing rumblings of a severe recession in Canada. How could this affect oil and gas in the country?
Well, if there's a general recession, of course, demand will come down. But remember, the oil and gas industry has been in a recession since 2014. So we've had 5 lousy years, and the rest of the economy was doing pretty good. There's been significant underinvestment in the industry, and of course, if the commodity board takes off because of the shortages and low inventories, that's going to cause the next cycle to start with the commodity board leading the way because of shortages, similar to what we saw in 1970, 74 to 81. It was because of the fact that there was underinvestment in energy for a number of years. Same thing you could even argue from 1999 to 2002 underinvestment, and then 2002 to 2008 we had a massive cycle. So my view is we're getting ready for a significant commodity cycle across the board, and that for energy we're going to see from 60 today, probably 150 by the end of the cycle, and the TSX Energy Index low is 119, I think in August, September. I think before it's over we'll see 470, so you were looking at some pretty significant magnitude to the upside, which will provide some great opportunities. And many of these companies are good dividend providers, and you can buy some companies that have 4 or 5% yield, and you can find some companies that have much higher yields, where people are concerned about the sustainability. But if I'm right about higher commodity prices in the second half, those dividends are sustainable for those companies. So we cover a lot of that in our research, and we do highlight a number of names that we see as particularly attractive at this time.
Is the price of oil a good indicator for the real rate of inflation?
Well, the real rate of inflation is, they remove food and energy, when the government does the statistics. To them, the big issue is labor costs. And that, just like we saw in the 70s, if the costs of labor go up, that becomes a sustainable input into into inflation. And that's when the Fed and the central banks get nervous. So, energy is, cyclical more than others. And of course, it's also seasonally weather related. So when you have cold weather, the price of oil spikes up and that inflects the inflation. And then when you have in the summertime, air conditioning demand, that's when you see natural gas prices have a bump up, because of the strong, needs for electricity.
Canada and the fight for or against pipelines, what are you hearing?
Well, we're seeing, of course, the announcement, and Premier Kenney spoke out that we're seeing pipe going in the ground for the Trans Mountain on the Alberta side, and of course there still are some issues with First Nations going to courts to stop it. Again, I think over the next 6 months we're going to see that resolved, and the Trans Mountain, I think the federal government seems to be fully on side to building it. The question will be for future pipelines after that. And especially oil pipelines, and that's where I think the battleground is going to be because of those two bills that are seen as anti-pipeline and anti-shipping of oil from the West Coast. So I don't have an answer to that, but I think we're still going to be fighting this battle, a year or two down the road. And again, the Conservative Party needs a leader that to replace Andrew Scheer and take on Trudeau on this issue. So we have a vacuum that's going to take a bit of time to fill, and then wait to see how the PCs come up with a policy stance that and how they want to move forward, in terms of helping the industry, if that's the case, which I hope is the case.
Is the climate change campaign designed to destroy the oil and gas industry, and is climate change a political hoax?
Number one, I don't think it's a hoax. I think, look at Australia and all the fires there and all the problems we've had in the past and fires and, previous summers here and, the water levels in some countries coming up and, all those issues. So I think climate change is real. The question, though, is what do we do in Canada, and how does that impact the global, for the planet? And the big problem is you've got to stop using coal, which means India and China have to make a major change. And whatever we do in Canada is negligible relative to their use of coal. So I think that we're going to make more changes here. We're going to see, we're going to see carbon taxes. We're going to see the industry spending a lot of money on finding more efficient ways to produce energy with lower carbon footprint. And there's been a lot of success that really didn't get a lot of press in the past. But I think the industry is now talking about what they're doing to improve the environment. For example, Suncor, which right now burns oil for the electricity it needs up in the Fort Mac area, they're planning to build a cogen facility and use natural gas. That's going to lower emissions over 30%. And so there's a lot of things going on that the industry is doing in terms of less use of water, recycling of water, carbon capture, and then using natural gas versus other, fossil fuels that have a higher footprint. I think the industry should be getting a lot of credit for what they're doing, and yet the industry has been under attack, and it's only now that we're starting to see with Premier Kenney's war room and with the industry now speaking up in a greater degree of what they're doing, and the ESG reports that they're talking about when they have to file and say, here's what we're doing. I think the energy industry is probably a leader in terms of ESG, in terms of Canada relative to other industries, and I think they should be given a lot more credit, and people should be seeing that they're not sitting there, acting like they're a company in the in terms of the buggies, the horse and buggy, and that they want to keep that and not allow cars on the road. The industry is not like that. The industry is working to be, as environmentally friendly and clean as they can be. And of course, energy is used in so many products around us. Maybe we're not going to use it as much for auto transportation because we go to more electric vehicles, but we're going to still be using petroleum products for jet fuel and for so many other things that we use around us, that we're going to need energy decades and decades to come. The question is just what's the mix going to be?
What's new at the Schachter report?
Well, we just came out with our December issue, yesterday, and so that's in the hands of clients. And we did two things in there. One, we talked about the tax loss selling season and the bargains we think that are out there and that people can take advantage of. Depending upon if they're a large cap or intermediate or small cap, if they're a dividend model investor, if they're an energy or an energy service investor. And then we did a major piece on our outlook for 2020. So for investors interested in the energy sector, they can just go to our website. We have some free research there from our past reports. But if they want to, they can go and subscribe, and all the information is there on the pages when they enter the website.
And how can people find out more about the Schachter Energy Report?
Well, number one, just go to www.schachterenergyreport.ca, so SCHACHTER. And then we also do tweets, which we do once a week. So there's information on there. And then, just read the free reports, see what's going on. And then also, as you know, I'm very accessible to the media, both, yourself and then also regularly on BNN, Market Call. So people can be watching that. They can watch the tweets. And so we're providing a pretty, strong product with multi phases of information. The two reports that we do for 11 months of the year. December, we just do the one issue. I'm on BNN, almost every month or two. And then, of course, you and I have a dialogue every month or two as well.
And, of course, you can spot Joseph instantly on business television because he's got the biggest and brightest bow tie.
Yeah, I've got a couple Christmas ones, too.
Joseph, best of the holidays.
Best of the holidays to you and also to your listeners and for all of us, a happy, healthy, and prosperous 2020.
My guest has been Joseph Schachter, founder of the Schachter Energy Report online at schachterenergyreport.ca. He was speaking to us from Calgary. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, Joseph Schachter, and thank you for listening. If you have any questions for our guests or the show, you can send them to info@howstreet.com. Now stand by for a company showcase update from Larry Reaugh, the CEO and president of American Manganese. I'm Jim Goddard. We'll be back next week with more This Week in Money. Happy holidays, everyone.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and president of American Manganese. Merry Christmas, Larry.
Merry Christmas, Jim. It's looking like a good year building up.
Well, the past year for American Manganese, you made some major breakthroughs. You got your pilot plant up and going. Maybe just give us a bit of a sketch about how things went this year.
Well, we certainly never took a step backward. Certainly we missed some of our timing, and that's interesting. Some of that stuff gets out of our control. But, our results have been stellar. And, as far as moving ahead with our process and eventually going into commercial production, that is still the top of the agenda. We got a couple of patents in the last year. And again, I always talk about how important they are. I see people reporting on proprietary processes and everything like that. But, without a patent, you're leaving yourself wide open, and we're not leaving ourselves wide open. We've got patented processes, and we've pretty much papered all that, and we've got applications out in 7 or 8 different countries, and we should start hearing about some of that early this coming year. So. That is looking good. There's also regulations being put in place that will certainly speed up people's paying attention to a proper way of recycling these batteries. And like the UN, which is could put a lot of pressure on the European market when it comes to recycling, and not just the European market, but anywhere else. So you have to watch these things. All we know is that hey, we can actually build a plant and have a closed circuit, environmentally friendly. Everything is green about it, and it's a big plus for the company. So in the year, we had not only that, we got the pilot plant going and completed, and we've had good results from that. Certainly everything that we set out to do, we've done. We're going through a bit of a warrant exercise right now, so we're going into the new year without having to look at any kind of financing for a few months. So and we're looking forward to meeting with Cometco and squaring away a proposal on our what you would call a PIA in mining, which is a preliminary economic evaluation, and we want to get that rolling on here because that'll bring in bigger players. So, we can answer quite a few of those questions. We certainly don't see any roadblocks. Our cost is minimal, and our profits should be robust. But don't forget, we have to buy the material. We have joint ventures. And so that cuts into the profits, but it should still be a very profitable operation. And, I'm looking forward to meeting with our European potential partners, and that's the Battery Safety Solutions. And they have a video out, by the way, on what they're doing, and they're progressing very well. And if I can upload the video, I think you'll see Amy's name on one of their vans. So we'll see if we can get that done. So that is looking good. We got other submissions out of Europe that are looking at actually potentially building a plant, big major companies. So I think it's been a stellar year for everybody and their shareholders. Certainly, we take our hat off to Cometco, who's are just marvelous. Call them geniuses when it comes to metallurgy. And without them, we wouldn't have a process. They started with us almost 10 years ago, and developed a process for low-grade manganese, and then we've taken that as a cornerstone and moved up to recycling lithium-ion batteries. And we're currently working on the Critical Metals Institute submission, and I expect that we'll have results on that very early in January. Again, we're finding some things that are teaching us lessons too on especially with the pouch batteries and getting the glues off. We had to actually do a different thing to get those adhesives off of the battery because they were really tightly sealed. But we've done that, and we're moving ahead with the program.
Larry, for people new to American Manganese, what is the company all about?
American Manganese is a critical metals company. They certainly have a solution for supply of manganese, and again, I use the old saying that you can't make steel without manganese, and if you can't make steel, the world stops. And they've got only low-grade deposits in the U.S. We have a methodology of actually producing electrolytic manganese metal and electrolytic manganese dioxide. And that's on the back burner right now, waiting for better prices in those, but that is a solution that could all of a sudden become critical at any time with all the tension in the world. We've taken that process, and we've developed a process now for recycling lithium-ion batteries, which again brings a lot of critical metals into the realm of production in the U.S., and that is, the cobalt, nickel, manganese, and aluminum, and of course the lithium itself. So it's a great process. We hold 3 patents currently in the U.S. We hold 3 other patents on the manganese in different countries, and we got 7 or 8 applications out for more patents, and in different countries. So, and we got another one that's developing, and next year we'll be applying for that patent. So things are, when we look at the what we're doing, there's no shortcuts. You have to do it properly. This is a new technology. It's going to create new fabrications for different equipment, and so we're basically, Jim, we're trying to cover all the bases that we can. The company has a website out there that has a lot of information to do due diligence on, and that's AmericanManganeseInc.com. You can phone the company at 778-574-4444. You can email me at LREAUGH@AMYMN.com. And we're traded on the Toronto Venture Exchange under the symbol AMY. We're traded on the U.S. Exchange under the symbol AMYZF, and we're traded in Frankfurt under the symbol 2AM. So you can get all the information that you need from us, and we wish you all a Merry Christmas.
All the best to you, Larry, and your family.
Thank you.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on December 20th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.